presented as official confirmation. And instead of calming tensions, the situation escalated dramatically. According to released figures, 165 ballistic missiles launched 2 cruise missiles, 541 drones deployed. Over 150 missiles intercepted dozens of drones, destroyed civilian areas, struck regional damage, and casualties have been reported across multiple areas. Iran also stated it targeted the U.S. aircraft carrier USS Abraham Lincoln with ballistic missiles. Whether impact occurred or interception succeeded remains unclear. Officials on multiple sides indicated operations may continue, and that's when markets started reacting. The real shock isn't just missiles, it's insurance. Roughly 20% of global seaborne oil flows through the Strait of Hormuz. War risk insurance premiums for tankers jumped sharply. Some vessels dropped anchor. Several carriers reportedly paused transit. When insurers hesitate, ships don't sail, even if the waterway is technically open. 2 commercial vessels were reported damaged near the entrance to the strait. Insurance costs per voyage surged. Tankers began waiting offshore. Oil responded instantly. Brent crude surged toward $80 per barrel over the weekend, holding gains instead of retracing. This is what economists call a negative supply shock. Beyond Hormuz, strikes reportedly extended toward key regional ports. Jebel Ali Port handles roughly 60% of UAE imports Mina Salman, near US. Fifth Fleet operations. Port of Haifa, critical energy gateway Duqm Port, built to bypass Hormuz risk. The strategic implication? Ports are harder to defend than ships. Infrastructure disruption impacts supply chains immediately. Energy flows, trade routes, import economies, it's all exposed. While traditional futures markets were closed, crypto-linked, tokenized physical markets continued trading. Tokenized gold products like Pax Gold surged above prior spot closes. Weekend silver pricing across offshore platforms spiked near $100 in some venues. In China, physical silver premiums widened sharply in Shenzhen buyback markets, significantly above Western paper closes. Shanghai futures traded at a notable premium. Shenzhen physical reportedly even higher. When physical markets trade materially above paper markets, that signals stress in price discovery. Not guarantee, not certainty, but stress. Reports indicated a major Chinese financial institution issued risk notices regarding gold liquidity during extreme price deviation scenarios. When liquidity warnings appear in gold markets, it means demand pressure is real enough to require formal communication. Large WEN savings pools are waiting for market open. If Western futures open significantly below physical Asia pricing, arbitrage tension builds immediately. That's the key thing to watch. Gold rises during fear. Oil rises during supply disruption. Silver sometimes lags. Right now, all 3 are moving together. That combination is rare. Gold, monetary hedge. Silver, industrial plus, monetary hybrid. Oil, unprintable energy necessity. When all spike simultaneously, markets are pricing systemic stress, not just headlines. Countries heavily reliant on Hormuz flows face immediate vulnerability. Japan, majority of oil imports transit the Strait South Korea, significant Gulf exposure India, major Gulf crude dependency China, largest absolute buyer, though more diversified fuel prices feed directly into inflation, currency pressure, and GDP growth. This is macro-level impact, not just commodity trading noise. Weekend premiums often exaggerate moves. When futures reopen, gaps can fill, risk can de-escalate. Insurance pricing can normalize diplomatic channels, can intervene. Physical premiums can compress if futures sell off aggressively. We've seen coordinated volatility management during prior geopolitical shocks. Nothing is guaranteed. Even before this weekend, silver logged multiple consecutive green monthly closes. Gold hit repeated record highs. Central bank gold buying remained elevated. Silver lease rates had been rising industrial demand. Solar, EVs, AI, defense, 5G, continued mine supply growth lagged demand growth. Those fundamentals didn't T-start this weekend. They were already present. Geopolitics may have simply accelerated price discovery. Size of gold and silver futures gaps. Whether Shanghai premiums widen or compress. Duration of military operations. Insurance normalization in Hormuz. Whether oil holds gains or retraces. Silver lease rate behavior. If futures open far below physical pricing, arbitrage pressure becomes immediate. If they open aligned with physical markets, it confirms weekend price discovery. This is not about hype. This is about energy choke points, insurance risk, physical metal premiums, structural supply deficits, monetary uncertainty. 3 assets are central in this environment: gold, silver, oil. Everything else trades on sentiment. These trade on necessity. Markets reopen soon. We'll see whether futures align with physical reality or try to fight it. Stay focused, watch the data, act on logic, not emotion.